Imagine waking up one morning and seeing the stock market in free fall. Panic is everywhere. Headlines scream about billions lost, banks teeter on collapse, and investors are frozen, unsure what to do next. In moments like this, one thing becomes crystal clear. Not all assets are created equal. While Wall Street shakes, one silver lining literally shines through the chaos. Silver. History shows that during the 1980, 2008, and even 2020 market crises, silver didn't just survive, it surged, rewarding those who understood its patterns. And if you stick around for the next few minutes, I'll show you exactly why silver can be your financial lifeboat when markets sink. Before we dive deep, make sure you hit that like button and subscribe, because the insights in this video aren't just numbers, they're survival lessons for your wealth. Trust me, missing out here could cost you. Now, let's go back to 1980, when silver captured the world's attention in a way few commodities ever have. In the late 1970s, inflation was running wild. Gas prices were skyrocketing, groceries felt like luxuries, and the dollar was losing its grip. Investors sought refuge, and silver became the hero of the hour. In just a few months, its price jumped from around $6 an ounce to an astonishing $50. It was a historic surge, fueled by fear, greed, and a unique combination of market manipulation and investor frenzy. Ordinary Americans were buying silver coins, bars, and futures, hoping to protect their savings. And here's the key takeaway. Silver didn't just rise randomly. Its surge followed clear patterns of demand, speculation, and global uncertainty. Fast forward to 2008. The world faced the worst financial crisis since the Great Depression. Banks failed, stocks plunged, and people everywhere felt the weight of uncertainty. Once again, silver stepped into the spotlight. Unlike many assets, silver acted as a hedge. Its price initially dipped as investors liquidated everything, but soon it rebounded sharply, climbing over 50% in a matter of months. Investors who recognized the historical patterns of silver during crises were able to not only preserve wealth, but multiply it. And then came 2020. The global pandemic froze economies and sent markets into a tailspin. Governments printed trillions in stimulus, interest rates dropped, and inflation fears surged. Silver once again responded predictably, reaching multi-year highs. It followed the same playbook it did in 1980 and 2008. Fear drove demand, supply lagged, and the result was a remarkable spike in value. What's incredible is that despite decades passing, the patterns remained surprisingly similar, giving us clear lessons if we know where to look. By the end of this video, you'll understand 5 historical silver patterns that every investor must know, and you'll see exactly how to position yourself to take advantage of them in future crises. Stick with me, because what you're about to learn could protect your wealth in ways most people overlook entirely. Let's start with the first pattern, and it begins with fear-driven demand. In every market crash, silver surges because people panic and seek a safe haven. Take 1980, for example. Investors were terrified of inflation eating away their life savings. Ordinary Americans, hedge funds, and even governments turned to silver as a tangible store of value. The surge wasn't just about speculation, it was about trust. When paper money feels unstable, people instinctively reach for something real. That's why silver skyrocketed from $6 to $50 per ounce in just months. The lesson? Fear triggers buying behavior that can push prices far beyond normal levels. Moving to 2008, fear looked different but had the same effect. The banking system itself seemed fragile. Lehman Brothers collapsed, AIG teetered on the brink, and people were unsure which institutions could survive. While many investors sold off stocks in panic, silver became a beacon. After a brief dip due to liquidity needs, silver climbed steadily, breaking through pre-crash highs. The pattern was familiar. Initial panic selling followed by a flight to safety. Recognizing this rhythm could have helped investors position themselves before the rally began. Then in 2020, the world faced a crisis unlike anything most had experienced. Lockdowns, economic shutdowns, and massive stimulus created uncertainty on a global scale. Investors didn't just want returns, they wanted security. Silver responded almost exactly as it had in the past. Initial volatility, followed by a strong surge. By mid-2020, silver prices had jumped more than 40% from their lows. The common thread? Fear triggers a predictable spike in demand whenever confidence in the broader financial system collapses. But here's something most people miss. Fear alone doesn't create maximum gains. Timing is everything. In all 3 crises, silver's biggest surges happened after the initial panic, when the public started realizing that paper assets might fail. Those who jumped in during that window captured the highest returns. Understanding this subtle pattern is critical if you want to leverage silver during market chaos. And while fear-driven demand explains why silver spikes, the next pattern shows how supply constraints amplify the move. We'll cover that in just a moment. But before we go deeper, remember to hit like and subscribe so you don't miss the next part where I reveal the second silver pattern that most investors completely overlook. The second pattern you must understand is supply constraints. Silver isn't unlimited, and during crises, shortages can amplify price spikes dramatically. Let's go back to 1980. As investors and speculators rushed to buy silver, the physical market couldn't keep up. Dealers ran out of coins and bars, futures contracts were stretched to the limit, and demand far outpaced available supply. This scarcity effect supercharged the price rally. People weren't just buying silver, they were competing for it. And when competition heats up, prices explode. That's the second key pattern. Limited supply meets surging demand, creating rapid price acceleration. Fast forward to 2008. Mines were producing steadily, but physical silver availability lagged behind investor appetite. ETFs were emerging as popular investment vehicles, and millions of investors sought silver in both paper and physical forms. When financial institutions began selling off other assets to cover losses, silver faced sudden spikes in buying pressure while supplies were constrained. Prices surged, rewarding those who had positioned themselves early. It's a classic case of scarcity driving outsized gains. Then came 2020, a crisis amplified by a global pandemic. Supply chains were disrupted, silver mining slowed, and delivery of physical silver faced delays. At the same time, demand was skyrocketing, not just from traditional investors, but from retail buyers and industrial users who needed silver for technology and medical equipment. The result? A price rally that mirrored the historical spikes of 1980 and 2008. Even minor delays in supply caused outsized price moves, demonstrating how sensitive silver is to availability. This pattern isn't just about buying silver, it's about understanding when scarcity intersects with panic buying. The timing can make a huge difference between modest gains and massive returns. Investors who recognize the moment when physical silver is tightening in supply can often ride the early surge before the mainstream jumps in. And here's a secret most people overlook. Supply constraints are amplified by psychological factors. Once the public hears about shortages, FOMO, fear of missing out, kicks in, pushing prices even higher. That's why silver's biggest spikes aren't always when demand starts. They often occur a little later when scarcity becomes obvious to everyone. Next, we'll explore the third pattern, which explains why historical cycles repeat and how you can anticipate silver's next big move. But before we continue, make sure you hit that like button and share this video if you're learning something new. This is the kind of knowledge most investors miss entirely. The third pattern is one of the most powerful. History tends to repeat itself. Silver has a way of following cycles that investors who pay attention can predict. Look at 1980. After a long period of rising inflation and economic uncertainty, silver skyrocketed, peaked, and then corrected sharply. The same thing happened in 2008. Initially, there was panic selling, then a rapid surge, followed by a pullback once the immediate fear passed. And in 2020, silver followed an almost identical trajectory. A sudden dip in March, a sharp recovery in the following months, and a period of volatility afterward. What this teaches us is that silver moves in waves, not straight lines. Understanding these cycles is crucial because it allows investors to anticipate turning points rather than react blindly. In 1980, those who noticed the buildup of fear, scarcity, and speculation entered early and rode the first wave. The same happened in 2008 with silver ETFs and physical bars, and again in 2020 when both institutional and retail investors pushed prices higher. Each crisis followed a familiar rhythm. Uncertainty triggers demand, scarcity amplifies it, and human psychology drives prices to extremes. Another thing to notice is the timing of peaks. Silver rarely reaches its highest point at the exact moment of market panic. Instead, the peak usually comes a few weeks or months after the initial shock, when fear-driven demand combines with limited supply and widespread attention. This lag is a golden opportunity for investors who understand the pattern. Recognizing historical cycles allows you to see the crisis for what it is, not just chaos, but a predictable environment where silver tends to shine. Cycles also explain why silver sometimes underperforms in the early stages of a crisis. In 2008, for example, silver initially dropped as investors liquidated assets for cash. But once the panic settled and the public realized paper money was losing value, the next phase of the cycle kicked in, sending silver soaring. The same sequence occurred in 2020 during the pandemic market crash. Knowing these cycles ahead of time means you don't panic during the initial dip. You position yourself for the surge. By tracking these repeating patterns, you can start to connect the dots between past crises and potential future moves. And while cycles provide a roadmap, the fourth pattern reveals why investor psychology can create extreme surges beyond what fundamentals alone would suggest. The fourth pattern is one that most investors completely underestimate. Psychology drives silver prices as much as supply and demand. In every major crisis, 1980, 2008, and 2020, human emotion played a decisive role. Fear, greed, and the fear of missing out, or FOMO, can push silver far beyond its perceived value. In 1980, people weren't just buying silver to protect wealth. They were chasing a surge they feared they'd miss. Lines formed at coin shops and bars were snatched off shelves faster than anyone could restock them. Panic turned into frenzy, and prices exploded. Fast forward to 2008. After the initial shock of the financial collapse, many investors realized their cash and paper assets weren't as safe as they had hoped. Anxiety spiked, media headlines amplified the fear, and suddenly silver was the go-to safe haven. The psychology of crisis amplified the cycle. Even those who didn't initially plan to buy silver jumped in, worried they'd miss the opportunity to preserve wealth. This mass psychological response creates surges that are often faster and more extreme than anyone predicts. Then in 2020, during the pandemic crash, the pattern repeated almost exactly. Retail investors, seeing dramatic headlines and market volatility, rushed online to buy silver coins, bars, and ETFs. Social media buzz intensified the rush, creating a viral effect. Suddenly, what started as a safe haven purchase became a self-reinforcing surge. Silver prices jumped because psychology amplified the existing supply-demand imbalance. In short, people's reactions can move markets faster than fundamentals. Here's the key takeaway. Understanding psychology gives you an edge. Crises create not just opportunity, but predictable patterns of human behavior. Those who anticipate panic-driven buying can position themselves to capture the surge instead of being left behind. The timing is crucial. The largest gains often occur when most people are still doubting, fearful, or skeptical. Recognizing the emotional cycle is just as important as tracking supply, scarcity, or historical trends. And while psychology explains why silver sometimes spikes dramatically, the fifth and final pattern ties everything together. Macro triggers and systemic shocks that set the stage for silver surges. This pattern shows you why silver rises before, during, and after crises, and how to spot the next big move before it happens. The fifth pattern ties everything together. Macro triggers and systemic shocks are often the spark that sends silver prices soaring. In every major crisis, 1980, 2008, and 2020, external events created fear, uncertainty, and massive shifts in investor behavior. In 1980, rampant inflation, rising interest rates, and geopolitical tensions combined to shake confidence in the financial system. Investors didn't just react, they fled to silver, a tangible asset that had historically held value. The spike wasn't random. It was triggered by a perfect storm of economic, political, and social factors. In 2008, the global financial system faced a systemic shock unlike any seen in decades. Lehman Brothers collapsed, credit froze, and governments scrambled to stabilize banks with trillions of dollars. Investors realized that cash wasn't always safe and stocks could plummet without warning. Silver reacted, as it had in 1980, but with a modern twist. ETFs, futures, and online trading accelerated the response. Prices surged rapidly once the magnitude of the crisis became clear. The macro trigger wasn't just the collapse itself. It was the realization that the financial system could fail and paper wealth could evaporate overnight. Then in 2020, the pandemic created a shock that was both economic and societal. Lockdowns, supply chain disruptions, stimulus measures, and historically low interest rates combined to unsettle markets worldwide. Investors rushed into silver for protection, and prices responded in kind. What's remarkable is that despite the differences between 1980, 2008, and 2020, the pattern was consistent. A systemic shock sets the stage, scarcity amplifies the effect, fear and psychology drive the surge, and silver becomes the go-to safe haven. Recognizing macro triggers can give you a huge edge. You don't need to predict the exact day of a crisis. You just need to watch for signs like inflation spikes, credit stress, geopolitical unrest, or massive monetary stimulus. These events often act as the tipping point, creating conditions where silver's historical patterns are likely to repeat. By combining all five patterns, fear-driven demand, supply constraints, cyclical history, psychology, and macro triggers, you start to see a roadmap for understanding silver in crises. And here's the exciting part. These patterns aren't just history. They offer clues about the future. Silver doesn't move randomly. It follows logic, timing, and human behavior. If you pay attention, you can spot opportunities before the crowd does. Up next, we'll break down how to read market signals and position yourself using these five patterns so you can maximize gains while minimizing risk. Now that you understand the five patterns behind silver surges, the next step is practical application. How do you actually use this knowledge to position yourself during a crisis? The first thing to watch is early warning signs. In 1980, investors noticed rising inflation, geopolitical tensions, and a sudden spike in silver buying. Those who recognized the pattern bought early, before the mainstream panic began, and captured massive gains. The lesson? Don't wait until everyone is talking about it. Look for signals before fear becomes widespread. In 2008, the signals were slightly different, but just as clear. Housing markets were collapsing, banks were under stress, and central banks were injecting liquidity at an unprecedented scale. These were macro triggers signaling systemic risk. Investors who understood the pattern of silver responding to financial shocks could enter with confidence, knowing that supply constraints and fear-driven demand would soon push prices higher. Timing matters more than perfection. You don't need to hit the absolute bottom. Positioning early in the build-up phase is enough to capture significant gains. 2020 offered another lesson in practical application. With the pandemic shutting down economies, markets fell sharply, and stimulus measures were announced. These were signs of both macro shocks and potential inflation. Silver initially dipped as people sold assets for cash, but those who recognized the historical cycles and psychology of mass panic knew the surge was coming. Entering at this stage allowed savvy investors to ride the wave upward, even as others hesitated. Understanding that silver often rebounds after initial fear-driven selling is crucial. Another tip is to diversify your silver holdings. Physical silver, ETFs, and futures each respond slightly differently to crises. In 1980, coins and bars were most valuable. In 2008, ETFs added liquidity. In 2020, online trading and delivery delays created unique opportunities. By using multiple forms, you can capture gains while managing risk. Finally, remember the human factor. Observe sentiment in the market, media coverage, and social buzz. Fear and FOMO amplify trends, so tracking psychology helps you anticipate surges before they peak. Combine this with supply analysis and macro triggers, and you have a complete roadmap for leveraging silver in turbulent times. Next, we'll examine lessons from each historical crisis, 1980, 2008, and 2020, so you can see these patterns in action and understand the real-world results of positioning correctly. Let's compare the silver surges of 1980, 2008, and 2020 side by side to see the patterns in action. In 1980, silver started the year around $6 per ounce. Fear of inflation, geopolitical tensions, and strong speculative buying pushed it to nearly $50 by January. That's an increase of more than 700% in less than a year. Scarcity played a huge role. Physical coins and bars were nearly impossible to find, and mass psychology fueled a buying frenzy. Investors who entered early rode the wave, while latecomers often bought near the peak, learning the hard way that timing is everything. In 2008, silver behaved differently, but followed the same underlying patterns. It began the year near $14 per ounce, dropped briefly during the initial panic in September as investors sold everything for cash, and then surged to over $20 by the end of the year. Here, ETFs, futures, and global awareness amplified the effect. The supply-demand imbalance, combined with fear-driven buying and macro shocks like bank failures and massive stimulus, created a 50-60% rebound in months. Recognizing the early signs of systemic risk allowed some investors to profit even in a volatile environment. Then, 2020 brought a unique scenario. Silver started around $18 per ounce, fell sharply to $12.13 during the initial pandemic crash, and then surged to over $29 in just a few months. The combination of macro triggers, disrupted supply chains, retail frenzy, and low interest rates created a perfect environment. Once again, history repeated itself. Initial panic, followed by a strong surge fueled by fear, scarcity, and psychological momentum. When you line up these three crises, the patterns are strikingly similar. In every case, silver acted as a safe haven during extreme uncertainty. The 5 patterns we discussed, fear-driven demand, supply constraints, historical cycles, investor psychology, and macro triggers, were all visible in each crisis. What's even more interesting is that the timing and scale vary, but the logic behind the moves is remarkably consistent. Studying these examples teaches a critical lesson. Silver isn't just a commodity, it's a crisis hedge. By understanding historical cases, you can anticipate moves in future crises and position yourself wisely. And in the next part, we'll dive into lessons you can apply today, using these historical insights to protect your wealth and potentially profit in the next market downturn. So, what can we learn from 1980, 2008, and 2020, and how can you use these lessons today? The first takeaway is simple. Don't underestimate silver as a crisis hedge. Many investors focus only on stocks or bonds, but silver has repeatedly proven its ability to protect wealth when markets tumble. Understanding the patterns, fear-driven demand, supply constraints, historical cycles, investor psychology, and macro triggers gives you a blueprint for positioning yourself before chaos hits. Second, timing matters. History shows that the biggest gains often come after the initial panic, not during it. In 2008 and 2020, silver first dipped when investors sold assets for liquidity, and only after the fear of systemic failure set in did it surge. By anticipating these phases, you can avoid panic selling and enter at the right moment. It's not about perfect timing, it's about recognizing the rhythm of a crisis. Third, diversify how you hold silver. Physical coins and bars give security against systemic risk, while ETFs and futures allow for flexibility and liquidity. In 1980, physical silver drove the surge. In 2008, paper instruments accelerated moves. In 2020, both played a role. By spreading your holdings, you reduce risk while remaining positioned for upside. Fourth, watch macro triggers and sentiment. Inflation, interest rates, geopolitical tensions, and market volatility are signals that silver may soon respond. Combine these triggers with historical cycles and psychology, and you start to see where the market is likely to move. This is how professional investors stay ahead of the curve. Finally, don't ignore the human factor. FOMO and panic amplify trends. Social media, news coverage, and mass psychology often create price spikes faster than any fundamental change. Recognizing these emotional waves allows you to ride the surge instead of being caught off guard. By applying these lessons today, you're not just following history, you're preparing for the future. Silver isn't just a commodity, it's a tool to preserve and grow wealth during uncertainty. And in the next part, we'll wrap up the video with a strong conclusion, final thoughts, and tips on how to stay alert for the next silver surge, plus a special CTA to comment, share, and engage. As we wrap up, let's bring it all together. Silver has consistently proven itself as a safe haven during market crises. From 1980 to 2008 and then 2020, the patterns are clear. Fear-driven demand, supply constraints, repeating historical cycles, investor psychology, and macro triggers all combine to create powerful surges. Understanding these patterns isn't just academic, it's practical. It gives you a roadmap for protecting your wealth and positioning yourself to benefit when markets panic. The key lesson is this: silver isn't random. It responds predictably to human behavior and global events. When you see fear in the market, notice shortages in supply and observe macro shocks unfolding. Silver often leads the way. By studying past crises, you can anticipate trends, avoid common mistakes, and make decisions based on patterns, not speculation. Timing, preparation, and understanding psychology are your most powerful tools. Remember, crises can come unexpectedly, but the 5 silver patterns provide guidance. They show you when to enter, when to hold, and when to be cautious. Whether you're holding physical silver, ETFs, or futures, knowing these lessons from history gives you a strategic edge. In every major market crash, silver rewarded those who understood the signals and punished those who ignored them. Now it's your turn. Watch the markets, pay attention to macro triggers, and remember the lessons from 1980, 2008, and 2020. If you apply these principles, you can protect your wealth and even profit during the next surge. And here's something important. Share this video with friends and family who want to safeguard their savings, and leave a comment below with your thoughts or questions. Which crisis lesson surprised you the most? Finally, if you found value in this video, hit like, subscribe, and turn on notifications so you don't miss the next breakdown of market insights, precious metals, and investment strategies. Silver isn't just a metal, it's history repeating itself. And now you have the roadmap to understand it. Stay alert, stay informed, and be ready to act when the next crisis hits.